At True Potential, we put a lot of emphasis on diversification, not just between different asset classes or regions of the world, but between different styles of investing. Each style has its own characteristics and generally comes into its own at different stages of the market cycle. Examples of investing styles include value and growth. In recent months, it appears that value has been edging back onto the radar. Value investing describes a process of buying assets regarded as undervalued and priced below their intrinsic value. Some companies may be cheap for a reason. They may reflect poor quality management or poor trading outlook. On the other hand, some may be cheap because the market has not yet realised the potential they offer. The process of filtering, screening, and doing the analytical work to identify these hidden gems is long and intensive, but can bring about significant opportunities for return. This typically works best in stressed or volatile market environments, when investors don't have the benefit of a rising market to lift stock prices across the board. Analysts review a range of financial metrics to assess the financial health of a company and calculate the intrinsic or true value of a stock. The intrinsic value can then be compared to the current share price to allow the analyst to judge if the stock is over or undervalued. The ethos of value investing rests on the basis that markets are not fully efficient. In other words, that the share price does not reflect all the information available on the company. What assets it has, what areas it may be moving into, what the plans the management has for the business, etc. However, modern financial screening systems and filters now take a lot of the time-consuming donkey work out of the initial selection process. Value stocks have performed well over the last 10 years, up 235% in US dollar terms, but it's important to see how that compares to other investment styles. An alternative style to value investing is growth, where investors are not so much looking for something that is valued at less than it's currently worth, but for a company that is valued at less than it will be worth in future if everything goes according to plan. This is a less contrarian approach and aims to gain exposure to those companies which offer above average levels of expansion. The most famous examples of late being the darlings of the tech sector: Facebook, Apple, Amazon, Netflix, and Google. Chart 1 illustrates that growth stocks have outperformed value for much of the last decade and have been particularly strong over the past 4 years, driving many returns experienced in global equities. However, after being in the shadows for 4 years, it appears that the gap in returns between value and growth is converging. The second chart rebases this analysis over the longer term and demonstrates that generally over the last 20 years, value stocks have outperformed their more glamorous counterparts. In this example, you can see that value as a style has significantly outperformed the wake of market downturns in 2000 dot-com bubble and the 2008 financial crisis, to name but two. Within the True Potential portfolios, we don't just rely on one of these styles, in the same way that we don't rely on one single asset class or region for returns. We are partnered with global managers who implement a range of styles. For investors, this means we aren't solely dependent on the market environment being right for the style of portfolios. We can adapt portfolios to be right for the style of market environment. We call this advanced diversification. Thank you for watching. Subscribe to our YouTube channel for more videos.